Good morning, everyone. Jeff Fratarcangeli here for another Friday Fratarcangeli Market Update. Thank you for joining me today on Friday, September 5th. On the heels of the jobs report that just came out, we came in at 22,000 new jobs, and we were expecting 75,000 new jobs. That is a sign of a slowing economy, which feeds well to interest rates as we come upon next week's Fed report by Jerome Powell as to whether they're going to lower interest rates for the first time in 2025. We're expecting a 95% probability of a decline in interest rates, and now that increase is probably going to go towards 50 basis points. Instead of a 25 basis point decline, the market's calling for a 50 basis point reduction in the short-term interest rate, which will bring us down to 4% or below on the short-term rates. That could be a huge relief across the board for revolving credit. It also has affected the 10-year mortgage, which has dropped from 4.4% over a week ago down to roughly 4% this morning. That is such a big impact out there to mortgages and folks out there that have revolving debt, and it really could hit home with real estate as well as a number of other businesses that are being affected by higher interest rates. This is something the market has been hoping for and calling for, and we're starting to see the market react to that this morning with the NASDAQ moving up solidly up about a half a point. Yesterday, we had a big move as well in the market. So we've had so far in September, which has historically been one of the most volatile, downward trending market months of the 12 months of the year. And so here we are today expecting more volatility in September potentially, but yet actually getting a little bit of a reprieve. I think there's something called FOMO out there. Many investors going back to April who were very skittish with the market, with tariffs and all the uncertainty, missed out on the opportunity when the markets were down between 13 and 17% to get some monies into the market for their long-term exposure. And unfortunately, right now, they're sitting back thinking, we missed out the first time. If the pullback occurs here in September, we're going to come in and pounce. And I think that could be playing into the typical September pullback here in 2025 on the heels of a major pullback in April. So we'll keep our eyes on that. And I will also just warn everyone, for those that are in it for the long term, we don't want to be reactionary. I'll talk a little bit more about that as well. Next topic is going to be earnings. We had Broadcom come out and report earnings last evening and beat both on the top and bottom line. The stock is up over 14% this morning and really starting to run. It's one of those semiconductor manufacturers that hasn't gotten a lot of press, but is certainly seeing some major movement this morning and has had a phenomenal last couple of years. And it just leads on to the AI expansion and really the driver and the catalyst to this bull market that we've been a part of since April of this year. And before that as well, with the AI and the chip sector really carrying us with technology being the leader. Interestingly enough, we're coming off the second quarter earnings now, completing some of our last numbers coming in with Broadcom and retail last 2 weeks. And now we sit back and we just look over the numbers. 81% of the companies in the S&P 500 had beat their numbers. That is a really strong number, even better than the historical 79% beat that we've seen since 2011, when our industry started monitoring how companies have actually delivered based on what they had promised their numbers to look like. And so that is a very nice second quarter earnings report. And what's also interesting is the guidance. You know, many of us sit back in our industry thinking the market might be a little bit elevated. We're trading at multiples right now that are considerably higher than the norm or the average. We're trading at about 23 times earnings based on current earnings. Historically, to give you somewhat of a gauge, over the last 5 years, the average PE ratio or the inflated level of the market has been between 19 and 20 times earnings. So we're certainly trading a little bit higher. But we also need to mention that we've had double-digit earnings growth for 5 consecutive years now. And what's even more interesting is the expectations for 26 and 27. We're looking for 13% earnings growth in 26 and 13% earnings growth in 27. This is a major, major move to the upside on earnings growth. And the question would be, how are we getting such strong earnings? And I think there's a number of reasons. One, we have the monetary policy that is very fluid, allowing more and more liquidity into the system. We also have deregulation, the regulatory environment or the red tape that's being peeled back to allow companies and banks to really maneuver and take action relative to their business acumen and really business opportunity. But I also think it's the efficiencies and the productivity that's coming from all of the technological advancements. Going back to my early days of the 90s, we were looking for 4 to 6% earnings growth on average. Fast forward to today, we're looking at double-digit earnings growth now for 5 consecutive years, and we're looking for 13% in 26, as I mentioned, and 27. And if we just remember what I mentioned, and that 79% of companies had beat their expectations with earnings top and bottom line since 2011, and this year it's been north of 80. So if that holds to reason and companies continue to sustain their guidance, we'll probably beat that 13% earnings growth like we are this year. We were expecting somewhere around 11% earnings growth in 2025, and now we're targeting closer to 12%. So I think it's something that is a trend that hasn't gone away in quite some time, and it could be consistent the way things look for the next couple of years, which would bring down those multiples substantially, and we'd be looking at closer to 20 times earnings based on forecast over the next 2 years, which is much more in line to history. And I think it's an exciting time to keep our eyes on. And I'm just going to reiterate some points as we sit back and look at some of the most tumultuous months of the year. If you just look back over the last several years, if not decades, the 2008 financial collapse, we hit a pinnacle of that decline in September of 2008. We also saw major pullbacks throughout the September-October timeframe. If I just reflect back on 2022, we hit our lows in September and October. So historically, this has been the time of year where we've seen multiple movements to the downside in dramatic fashion. And for whatever reason, we're always a little bit hesitant and a little bit anxious coming into these months. And I'll warn our audience that, listen, we're in it for the long term. We're not in it for the short term. We want to understand how much liquidity we need to maintain, identify what our long-term objectives are, balance out between having liquidity as well as taking a longer-term approach to our investment strategies to be able to combat inflation. And let's not forget, the eighth wonder of the world, stated by Albert Einstein, was the power of compounding. If you think about allowing your money to continue to work and get into the longer-term investments like equities early and let it continue to compound over decades to come. I'll give you an example. The rule of 72 that many of you might have heard of. You take the interest rate of return and you divide it by 72, and you look at how long it would take for your dollars to double. So for example, if we look at a 10% average return and we have $1 million invested, we would double that $1 million in roughly 7.2 years. So in a matter of 20 years, $1 million invested would be worth over $4 million due to the power of compounding. So remember, it's not timing the market, it's time in the market. And our job here at Fratarcangeli Wealth Management is to identify our clients' near-term objectives, maintain a level of liquidity, and design an allocation that's going to allow their longer-term assets, the money that they know they're not going to need for at least 5 years or longer, to be able to sustain, not react to the emotions that come and go, the fear and greed that oftentimes pushes us to make decisions that are probably the opposite of what we should be doing, but maintaining that exposure long-term, dollar cost averaging, continuing to layer in our discretionary assets into our target allocation and be able to take advantage of the volatility and stay away from emotion. So we're here to let you know that we're here with all hands on deck, watching all the data come through, making sure we're prepared and leveraging every possible person or information or history of what has transpired in the markets, as well as where we're at today and how we should navigate the situation. And we are ready, willing, and able to help in any way that we may be needed. So I wish you all the best, and we'll see you soon. Bye for now.